Hello, everyone, and welcome.
I'm Amy.
And I'm Tom. We're thrilled you're joining us today. We're going to explore the latest financial insights. We've got quite a stack of sources here from Exante Daily Insights, really packed with critical market movements, some interesting corporate news, and central bank developments, all hot off the press from June 25, 2025.
Yeah, it's quite a bit to cover, definitely a broad scope. Our mission today really is to sort of cut through the noise. We want to distill the most important nuggets, give you a comprehensive but, concise understanding of what's really driving the global economy right now. And maybe more importantly, why it actually matters to you.
That's right. We'll be looking at, well, everything from these seemingly unstoppable stock market rallies to some surprising shifts in commodity prices. And I think crucially, the evolving, maybe sometimes divided stance of major central banks, like the Fed and the ECB. So get ready for some surprising facts and maybe some connections that tie it all together in ways you might not expect. All right, let's kick things off. Let's unpack the major market movements from this past Tuesday. Looking at the U.S., it seemed like a pretty strong day for stocks, wasn't it? Especially after, well, a bit of a mixed picture recently.
It certainly was, yeah. Strong day. All three major U.S. indices advanced pretty significantly. The NASDAQ 100 really led the charge there. It closed up, 1.53% at a record high, actually, 22,190.52. And what's interesting is that it's first record close since back in February. So that suggests some renewed strength, particularly in tech.
Since February, wow, okay.
Yeah. And the Dow Jones Industrial Average, it added a solid 507 points. That's up 1.19%. The S&P 500 advanced 1.11%. It's now less than 1% away from its own February record. And it wasn't just, a few big names carrying the market. 9 of the 11 sectors in the S&P 500 were actually up.
Oh, interesting. So pretty broad participation then.
Exactly. It shows broad market participation, which is generally seen as a healthier sign.
Right. That's a powerful rebound. So did European markets follow suit, or were they kind of charting their own course?
Well, European indices also saw gains, generally reflecting that positive sentiment we saw in the U.S. The German DAX was up 1.60%, and the French CAC 40 advanced 1.04%. The UK's FTSE 100 saw a slight increase, just 0.01%.
Okay, so positive across the board, mostly.
Yeah, mostly positive. Maybe not quite as dramatic as the U.S., but still a positive day for the major European bourses. It kind of shows that global interconnectedness, doesn't it?
It really does. And speaking of global connections, let's shift gears a bit to commodities. We saw some pretty big moves in gold and oil. What was driving those?
Yeah.
Especially that significant drop in gold. Usually it likes uncertainty.
Yeah, that's what's really fascinating here. You see the direct, almost immediate impact of, geopolitical news. Gold prices, often seen as that ultimate safe haven asset. They hit their lowest in over 2 weeks. Dropped 1.42% down to $3,320.42 an ounce.
Wow.
And this downturn was primarily due to the announcement of a ceasefire between Iran and Israel. Basically, when geopolitical tensions ease, even temporarily, that demand for gold as a hedge just diminishes pretty rapidly.
Right, the fear trade unwinds.
Exactly.
Okay.
And oil prices also dropped significantly. Brent crude was down 3.35% to $67.79 barrel. West Texas Intermediate fell 0.56% to $65.14, again, initially driven by those ceasefire expectations.
Right.
Reduced fears of oil supply disruptions in the Middle East, particularly around the Strait of Hormuz, which is, absolutely vital.
Right, the choke point, yeah.
The choke point, exactly. That alleviated concerns. It's really a textbook example of how peace talks, even just the news of them, can quickly calm commodity markets. Oh, and adding to the oil story, we also saw increased output from ExxonMobil down in Guyana.
Oh, right.
Yeah, output rose to 667,000 barrels per day in May, so that adds a bit more supply pressure, too.
It's incredible how quickly one piece of news can just ripple through so many different markets.
Yeah.
So how did currencies react to all this, especially the U.S. dollar? It sounds like it kind of bucked the trend by weakening a bit.
It did indeed, yeah. The dollar declined for a second straight day, down 0.39%, which is, as you say, a bit counterintuitive for some. Often the dollar strengthens when there's global uncertainty, but here, with the ceasefire news, that safe haven appeal just lessened. Meanwhile, the euro surged 0.26% to 1.1607. That's its highest level since October 2021, and sterling strengthened 0.67% to 1.3609, its highest since January 2022.
Okay, so quite significant moves there too.
Definitely. And this currency movement was largely a reaction to that Iran-Israel ceasefire news. What's particularly noteworthy, though, is the dollar weakened, despite Fed Chair Jerome Powell reiterating his expectation for inflation to rise this summer. You might normally think that would bolster the dollar, right?
It would, yeah.
It just goes to show how dominant geopolitical factors can sometimes be, at least in the short term.
Fascinating. Okay, so beyond the big market numbers and geopolitics, I'm always curious about the corporate world. That's where so much innovation and sometimes disruption really happens. What were some of the standout corporate stories that really captured your attention this week?
Absolutely. Well, one story that really grabbed my attention was MasterCard. They announced a significant integration of Feezer's blockchain-based token across its products.
Blockchain, yeah.
Yeah, this isn't just, making payments a tiny bit easier. It feels like a huge signal. This could be a kind of tipping point, maybe pushing digital assets from niche speculation towards, well, everyday commerce. It could fundamentally reshape how we transact.
So moving beyond just crypto trading into actual use cases.
Exactly. The real insight here might be how major financial players are now actively building the actual rails for a future where these crypto-backed transactions are maybe commonplace, perhaps even without consumers really realizing they're using blockchain underneath. It sort of moves digital assets from the if stage to the how stage.
That is a profound shift, almost like a quiet revolution in payments happening. And speaking of rapid changes, the self-driving car space seems to be heating up even more players joining the race.
Indeed. Uber and Waymo, they launched a self-driving taxi service in Atlanta. And this follows pretty closely on Tesla's recent robotaxi introduction. So it really raises important questions, doesn't it, about the future of urban transport, the competition in this sector. It's evolving so quickly.
It really is.
What's fascinating is how these companies are pushing directly into consumer services now.
Yeah.
It's not just R&D anymore. It signals a move from, theory to practical application, challenging traditional taxis, public transport.
Right. But while some companies are forging new alliances and innovating like crazy, it's also true that, well, not every partnership lasts forever in business.
Yeah.
We saw some interesting breakups and divestitures making headlines too, right?
No, apparently not. You're right. Krispy Kreme, for instance, decided to stop selling donuts in McDonald's restaurants.
Oh, I saw that. Seemed like a good fit initially.
It did, but they cited that the partnership just wasn't positively contributing to its financial performance. It might seem simple, but this kind of breakup highlights a common challenge. Synergy is hard. And even popular brands will cut ties pretty ruthlessly if a venture doesn't boost the bottom line quickly enough.
A good reminder.
Yeah, a stark reminder that even seemingly great collaborations aren't immune to market realities or, strategic misalignment. And on a similar note, but in banking, BBVA's 14 billion yuan bid for Banco Sabadell. Well, that faced a significant setback.
What happened there?
The Spanish government effectively blocked the immediate merger for several years. That's quite a rare direct intervention. It signals real government concerns about banking sector consolidation in Spain.
Interesting. So different reasons, but partnerships ending or facing hurdles in both cases. What about big media companies? They always seem to have their own unique set of challenges, often tied to debt and changing viewing habits.
Warner Bros. Discovery is certainly facing a significant one right now. They're seeing considerable interest from bondholders looking to sell back over $30 billion of notes.
$30 billion?
Yeah. And that amount is more than double what the company actually offered to repurchase, which indicates a real desire by investors to, offload that debt. Reports suggest they're preparing to restructure their liabilities and potentially even undergo a corporate split.
A split.
Yeah, it's a crucial moment for them. They're grappling with streaming profitability, massive content costs, and managing that huge debt load they inherited from prior mergers. It could really dramatically reshape the media landscape for one of Hollywood's giants.
Definitely one to watch. And in retail, it feels like companies are really thinking outside the box to speed things up for consumers, almost redefining the shopping experience.
That's a powerful trend, absolutely. Walmart is piloting dark stores.
Dark stores.
Yeah, essentially retail-like setups, but they're closed to the public, designed purely for efficient online order fulfillment. The whole purpose is just to accelerate delivery times. And similarly, Target is testing direct consumer product deliveries straight from the factories.
Cutting out warehouses.
Kind of. They're aiming to establish a service more like what, those Chinese e-commerce platforms like Temu and Shein offer. It just highlights the entire industry's laser focus on speed and efficiency, especially in that crucial last-mile delivery.
Is that about margins or just meeting customer expectations now?
It's probably a bit of both, I think, but mostly driven by the Amazon effect and this consumer demand for almost instant gratification.
Right, the new normal. Okay, let's pivot now to the central banks. particularly the Federal Reserve. The source is titled, "Will It Be a Divided Fed?" which immediately suggests, well, some interesting internal dynamics. What exactly did Fed Chair Jerome Powell say in his testimony before Congress that led to that kind of headline?
Well, Powell's testimony didn't really offer major surprises. It largely echoed comments he's made before. He consistently maintained the U.S. economy remains on pretty solid footing. He acknowledged the uncertain impact of tariffs on inflation, that's still a question mark. And he stated that current monetary policy is well positioned to just observe how things unfold.
Okay, so steady as she goes, mostly.
Mostly. He emphasized the Fed is in no hurry to ease borrowing costs. But he also indicated they would likely move to cut rates sooner rather than later.
Ah, there's the nuance. No hurry, but sooner rather than later.
Exactly. It suggests a very nuanced approach, trying to balance being vigilant against inflation with being responsive to economic conditions if they change. Oh, and a significant portion of the questions he got were also about the housing market. That's clearly a key area of concern for Congress.
Makes sense. So if they're in no hurry, but might cut sooner rather than later, what does this actually mean for interest rate expectations? Does that nuanced comment translate into a measurable shift in market sentiment? Are traders buying it?
Well, if we connect this to the bigger picture, Fed funds futures traders are indeed now pricing in a higher probability of rate cuts. For anyone wondering, these Fed funds futures traders are basically sophisticated investors placing bets on where the Fed's main interest rate will go. Their collective bets give us a good snapshot of market thinking.
Right, the wisdom of the crowd, sort of.
Kind of, yeah. Right now, there's an 18.6% probability of a rate cut in July. That's actually up from 16.3% just last week. But a September Fed meeting cut is now seen as the most likely outcome. The probability there is pegged at 85.3%.
85% for September. That's pretty high conviction.
It is. And overall, traders are anticipating about 59.5 basis points of cuts by the end of the year. Remember, a basis point is 0.01%, so just under 0.6% worth of cuts. And that's up from the 45.0 basis points expected just last week. So yes, market sentiment is clearly shifting towards expecting earlier cuts. They seem to be leaning towards the sooner part of Powell's statement.
Interesting. And what about that divided Fed idea from the source title? Does Powell's testimony reinforce that sense of internal disagreement? Or is it maybe more united than the headline suggests?
That's a really important question about internal consensus at the Fed. And yes, the division seems clearly present. Powell's testimony comes after a string of comments from other Fed officials that indicate a growing divergence in views, particularly on the timing of the next rate cut. Well, for example, Federal Governor Michelle Bowman, she's a permanent voting member on the Rate Setting Committee, the FOMC. She suggested a potential rate cut could happen as early as July. But then, on the other hand, you have non-voting FOMC members this year, like Atlanta Fed President Raphael Bostic and Cleveland Fed President Beth Hammack. They contribute to the discussion but don't vote on policy right now. They suggested a slower pace of adjustment might be more appropriate.
So definitely different signals being sent out.
Exactly. These different viewpoints are, a natural part of policymaking. But the fact they're commenting so publicly highlights a genuine, active debate happening inside the Fed right now.
It's not just the Fed navigating these complex waters, though. We also saw important insights from the European Central Bank. What's their take on the situation, especially given Europe's own unique economic landscape?
Exactly. Governor Francois Villeroy de Galhau, he's from the Bank of France, he stated that the ECB could implement further interest rate cuts, even if there's substantial energy market volatility, which is a critical point, right? Because Europe is so sensitive to energy prices.
Very much so.
And furthermore, the ECB's chief economist, Philip Lane, he remarked the battle against inflation was, in his words, largely completed. That's despite some persistent price pressure still lingering in the services sector. So it indicates a growing confidence at the ECB, even with those remaining pockets of inflation.
So what's the market thinking about ECB cuts then?
Well, the market consensus now seems to point towards one additional ECB rate cut this year. As inflation gets closer to their target, that would be pretty significant for the Eurozone economy.
Okay. And beyond just central bank comments, Germany's budget news also played a role in European fixed income, didn't it? How did that impact bond yields over there?
Yes, it certainly did. German long-term government bond yields, they actually rose after the cabinet approved a draft budget for 2025 and a framework for 2026. These fiscal plans include record investments. They're aiming to stimulate economic growth in Europe's largest economy.
More spending, potentially more borrowing.
Exactly. So the German 10-year yield was up 3.7 basis points to 2.547%. And this increase in yields happened despite the market still monitoring those Middle East tensions. It shows that strong government spending plans can significantly influence bond markets. Investors factor in the increased borrowing and the potential for economic expansion. It's a good reminder that fiscal policy, not just monetary policy, really drives markets.
Absolutely. So let's try and tie this all together. What does this all mean for you, the listener? We've covered a lot, haven't we? From record stock highs, corporate innovations, shifts in oil, that nuanced central bank talk. How do we connect these seemingly disparate dots into a coherent picture for, well, your world?
Yeah, I think the overarching theme here is just how incredibly interconnected everything is. These global events, geopolitical developments like that Iran-Israel ceasefire we discussed, they have immediate, measurable effects on commodities like oil and gold. And those effects then just ripple through currencies, through fixed income. For example, that slight decline we saw in U.S. Treasury yields because tensions eased, that directly affects borrowing costs for businesses, for individuals. It impacts everything from corporate investment decisions right down to your own mortgage rate.
It's not abstract.
Not at all. It really touches your wallet. And the mixed messages from the central bankers, that perceived division within the Fed, the nuanced comments from ECB officials, it just highlights how complex managing inflation and economic growth is globally right now. And their decisions impact, well, everything, from your mortgage rates again to the cost of goods you buy every single day. And on another front, that push for corporate innovation, we talked about MasterCard's blockchain integration, Walmart's dark stores. That shows how companies are constantly adapting to new market demands, new technologies, which ultimately affects how we transact, how we receive goods. It's this dynamic interplay between these big macro forces and these micro-level innovations.
So it seems like staying informed about both these macro shifts and these micro-level changes isn't just about, understanding the news headlines. It's truly about understanding the forces shaping your daily life and maybe your financial future. As these geopolitical currents, corporate strategies, central bank decisions continue to swirl, maybe consider how just one unforeseen event, perhaps a new tech breakthrough or another surprising policy move, how that could send ripples through your investments, your career, even your daily shopping. The only real constant, it seems, is change itself. Thank you for your attention today. We hope this helped make sense of some complex developments. You can subscribe to our podcast if you like it, and we'd appreciate that. See you next time.